Hi, I'm Daryl Jones, Director of Research at Hedgeye Risk Management, joined here by my colleague Hesham Shaaban, who does internet and media research for us. Today we're here to talk about Yelp. Hesham was actually one of the early bears on Twitter, which has been playing out negatively for us fundamentally. He's also negative on Yelp, so we want to get into that a little bit. But first off, can we talk a little bit about the Yelp business model?
Sure. So what Yelp does in a nutshell is they sell advertising space to local businesses on its website in order for these businesses to promote their businesses to traditional Yelp users.
Gotcha. And you're a little concerned about the business model. So, I mean, can we talk from a micro level what your sort of biggest issue is?
Yeah, I mean, structurally, their biggest issue is the fact that they can't hold on to their customers. So on an annual basis, Yelp is losing the overwhelming majority of the customers that they started out the year with.
Okay.
And to put it another way, their ending customer base in any year is comprised almost exclusively of members that they signed or customers that they signed that year.
Gotcha. So I guess despite this high attrition rate, can they get bailed out like a lot of growth companies just because the market's so massive?
Yeah, I mean, that's the thing is that there is an assumption that their total addressable market is substantial. Yelp estimates it to be 27 million. However, that 27 million is the total U.S. market, the total number of businesses in the U.S., right? Now, you have to, if you think about Yelp's core customer, there's two criteria. One, they need to be retail customers because that's what Yelp's user base is. And two, they need to be able to afford Yelp's advertising program. Now, when you break down the data, what we found is 75% of all businesses in the U.S. make less than $100,000 annually. So to afford Yelp's minimum ad package of $3,600 is prohibitive.
Right, that makes sense. I guess taking it up a higher level, as you said, this is sort of a consumer or retail-focused advertising model. So are there some macro either headwinds or tailwinds that are impacting the company?
Yeah, I mean, there's two things. It's one, retail sales are slowing. We're seeing that across a bunch of different metrics, but more importantly, commodity costs are rising, right? And to put this in perspective, the CRB index, commodity index, is seeing its sharpest sequential increase since 2011.
Gotcha.
Now, the reason why this is important is that in order for Yelp to sustain growth, it needs to consistently add more new customers than it loses on an annual basis. And it's doing this in a market that's a lot smaller than either Yelp or the street realizes.
Gotcha.
So when you introduce this macroeconomic tailwind, which didn't exist last year, what happens is you have a nasty setup of heightened reasons for customers to leave Yelp, cease their programming, and it's a much tougher selling environment at the same time.
I think you actually meant headwind instead of tailwind, but you're spot on. So I guess thinking about the attrition issues and the top-down macro issues, what do you do with the stock here?
I mean, we're short.
Yeah.
We can't see a reason to buy it. After sifting through all the data and breaking down the company, I mean, this is a flawed business model in a challenging macroeconomic environment. So, in terms of the stock, we're staying short. We're going to need a pretty compelling reason to get off that short. And by this time next year, we're expecting this to be a $30 to $40 stock.
Just to summarize, as you can see, Hesham's a major bear on Yelp. Two big things support his thesis. First, we think Yelp's a flawed business model, which is making customers flee quicker than they normally would. The second thing is there are major macro headwinds that are going to impact their ability to incrementally sell this year. If you have any questions, feel free to tweet me at HedgeyeDJ or Hesham
At Hedgeye Internet.
Great, thank you.